Shinshin World View, know about the world together. New round of quantitative tightening by the Fed, VND420 trillion retreat from Vietnam. The U.S. interest rate futures market on the 3rd of June showed a 100% probability of an expected 50 basis point hike at each of the Fed's next two meetings, followed by the Fed's most hawkish official, St. Louis Fed President Bullard, urging policymakers to quickly and sharply raise rates to 3.5% to curb surging inflation. And, in addition, Fed Governor Waller supporting several meetings to raise rates by 50 basis points each. Meanwhile, the Fed's new round of quantitative tightening, QT, era has also officially opened on June 1, with the withdrawal of about $600 billion of base liquidity expected by the end of 2022, which Fed Governor Waller said was the equivalent of carrying out 2 to 3 rate hikes of 25 basis points each, meaning that the U.S. market is still far from digesting the impact of tapering on financial markets. J.P. Morgan CEO, in a report published on June 2, warned the U.S. financial markets to be ready to meet the hurricane because the economy is facing a series of unprecedented challenges, including the Russian-Ukrainian conflict, and quantitative tightening because the economy is facing a series of unprecedented challenges, and recommended that investors also be prepared. Goldman Sachs expects that whether the Fed's path of rate hikes and tapering is accelerated or slowed down, it will seriously damage the liquidity of the U.S. financial markets, allowing dollar interest rates to rise and making asset prices volatile, because any asset price is measured by the price of money. The core here is the change in interest rates, the speed and expectation of balance sheet expansion, and the control of U.S. bond yields. This will not only create uncertainty in the U.S. financial markets, where market sentiment may be recurring, but will also create hardship for emerging economies with a homogeneous economic structure, high external debt, and a shortage of external reserves, where the dollar siphon effect will begin and will increase the volatility of financial markets. The logic behind this is actually quite simple. The US dollar is the world's main reserve and most important settlement currency and dominates the foreign exchange and commodity pricing power environment, so the US will be able to collect minting taxes from investors in these economies through an easy and tight dollar cycle and covertly pass on its own growing debt costs and inflation risks. Most of these countries are at the lower end of the industrial chain and have a greater dependence on the dollar. The Federal Reserve is expected to continue its aggressive monetary tightening policy, which will have a greater impact on these markets, and this trend will be more pronounced as the dollar liquidity ebbs, from flood to drought, in the process of bottoming out. Once these countries have a shortage of dollars in their reserves, combined with the rising cost of dollar financing, it will make the pressure to repay interest on foreign debt increase rapidly, which will lead to a plunge in the stock, bond and exchange markets, and even sovereign debt default. According to a new report cited by Bloomberg on the 31st of May, Lebanon, Turkey, Argentina, Brazil, the Czech Republic, Poland, Peru, Malawi, Sri Lanka, Chile, Mexico, Mongolia, Pakistan, Egypt and Indonesia are 15 vulnerable markets that may face a dollar shortage or high dollar financing costs due to a single economic development structure and a steep inverse pattern of foreign debt and foreign reserves. The latest news is confirming this analysis. Malawi, located in southeastern Africa and heavily dependent on agriculture for its development, suddenly announced on the 29th of May a 25% devaluation of its currency, the kwacha, and a return to a market-determined foreign exchange regime to shore up dwindling dollar-denominated foreign reserves. Sri Lanka, which relies on tourism as the backbone of its economy, also announced on the 20th of May the country's first sovereign debt default crisis in its history and warned that inflation could soon soar to 40%. The currency would depreciate sharply and available dollar reserves would be depleted as the country's economic pillar sectors were hit hard by the global public health crisis and external reserves continued to shrink. Historically, every easing and tightening of the dollar cycle always triggers economic and financial market shocks during the transition. Earlier vivid cases of this effect can be referred to Venezuela and Zimbabwe. In addition, Turkey, Argentina and Chile, 3 countries that have also repeatedly defaulted on their sovereign debt and have more serious external debt problems. The risk of a subsequent turmoil in the equity, debt and currency markets is still greater, but things do not end here. The end is not here, and the current market data appears more insidious. In recent times, the financial markets of India and Vietnam, where there is no shortage of foreign reserves, have also plunged, making the continued withdrawal of international funds even more implying that this round of the dollar-sucking effect on the market has started early, becoming the first market to be hit since the Federal Reserve tightened monetary policy, and the latest data is feeding back this change. According to the latest data released by the National Securities Depository of India on May 31st, a whopping 1.71 trillion rupees of international funds have been withdrawn from Indian financial assets so far in 2022, almost twice the net outflow during the 2008 financial crisis, and the Indian currency has now fallen to a record low against the US dollar, making it one of the worst performing currencies in the world. The VN30 index has also plunged 24.1% from its 2022 high as of May 29, with some sharp-sighted international funds retreating from the Vietnamese market in a big way due to strong selling pressure, with foreign investors selling a net VND420 trillion in portfolio financial assets as of May 30, almost 2.91 times more than in the same period last year, the Vietnam Express reported on May 31. Experts in the Vietnamese securities industry said that this downside risk will continue to dominate the market and will affect all aspects of the Vietnamese economy amid the current intensification of the country's financial market situation, coupled with global risk aversion, which poses a threat to highly valued assets represented by the Vietnamese stock market. In its latest report released in May, the IMF predicted that while Vietnam's external reserves are growing, the country's dollar-denominated external debt is expanding at a faster rate and has been ranked by international agencies as the country in Southeast Asia most in need of fiscal consolidation, while also facing increased macro risks such as escalating inflation, supply chain shortages, adverse weather factors, developments in the real estate and corporate debt markets, and negative impacts on many Vietnamese companies. Reuters also analyzed in an article published last week that Vietnam's economy is at risk of being set back 20 years as macroeconomic risks continue to rise. Welcome to subscribe and like it. If you have a new perspective, feel free to leave a comment for discussion.